Fed Chair Jerome Powell recently stated that it is still uncertain whether U.S. interest rates will need to rise further. Central bank officials are balancing the uncertainty related to the impact of past hikes and borrowing costs and recent bank credit tightening, with the fact that inflation is proving very difficult to control. Prior to the policy meeting in June, we haven't made any decisions about the extent to which additional policy firming will be appropriate. U.S. policymakers remain uncertain about their upcoming policy decision or receive important jobs and inflation data in the next coming weeks that could sway their debate within the central bank's rate setting Federal Open Market Committee. Powell said he felt that the data so far support the committee's view that bringing inflation down will take some time. He noted that some of the factors may keep inflation elevated, such as a tight labor market. We're not seeing that ease anytime recently, particularly in service industries where inflation is proving more persistent. Policymakers are forcing other constraints and offering clear guidance on the next meeting as well. Regardless of the data, the Fed is unlikely to raise interest rates if the down-to-the-wire political standoff over the federal debt ceiling remains unresolved, or if an actual U.S. debt default is the result. The central bank may even be pushed towards emergency steps towards easing the burden on the American economy. This week has seen some Fed policymakers call for a pause to further rate hikes, but others have pushed for more increases. While Vice Chair nominee Philip Jefferson, in remarks that walked down the middle of the road of the path, cited risks on either side with no clear recommendation. Atlanta's Fed President Raphael Bostic captured the mood earlier this week when he said that while he was inclined to keep interest rates steady at the June meeting, even that decision would not say much about the future. The 1/4 percentage point rate hike increased by the Fed earlier this month, as well as back in March of 22, raised the benchmark policy rate to 5 to 5.25 range. The level most policymakers have identified as the likely stopping point for rate hikes. The Fed's policy statement at that meeting opened the door to a pause. Through Powell in his post-meeting press conference, he said that it's not possible to say with confidence now. We're going to have to see the data accumulating before deciding whether the door was closed on further rate hikes. Data on inflation, jobs, and the banking industry have since done little to clarify the situation, with nothing seeming to change very fast. Job growth seems to be cooling but remains strong. Inflation appears to be falling but is still high. Overall demand, bank credit, and the economy look to be slowing, but also are holding up better than anticipated. The result has been a frustrating inconsistency with some of the arguments developed by policymakers since the last meeting. Tim Dewey, a chief U.S. economist at SGH Macro Advisors, along with Dovish officials, keeping the possible need for more rate hikes open. Hawkish ones are noting the risks of tightening credit, and some trying to have it both ways. Either way, it's getting to be a time to fish or cut bait, Dewey said, and either needs to agree that the economy needs time to fully adjust to the aggressive rate hikes enacted over the last year, a core argument for pausing, or stick with the hawkish position of waiting for inflation data to roll over and continue raising rates until then. Now, if you're in need of an experienced commercial real estate broker, I can be reached at 281-222-0433. I appreciate your time and have a good day.